I think your audio is off. Can you please unmute yourself?
Hi.
Hello?
Hi, everyone. Thanks for the introduction.
Yes, we can hear your voice clearly. So if you're ready, the floor is yours. Please begin the presentation.
Thank you. Thanks very much for the introduction, and thanks to the organizers for the opportunity to present at this seminar. Hello, everyone. The electric vehicles revolution is propelling strong demand growth for lithium, cobalt, and nickel. And exactly how strong these will be depend on the battery chemistry choice for mainstream EVs. My name is Alice Yu, and I'm the Senior Research Analyst for Metals and Mining Research at S&P Global Market Intelligence. I have a little cough today, so apologies in advance for any possible pauses. S&P Global Market Intelligence is the world's leading provider of end-to-end intelligence on the mining sector, with an unrivaled industry database covering all aspects of the mining value chain, from exploration through to M&A and corporate financials, as well as proprietary by commodity forecasts. For the presentation today, I'll be speaking for 20 minutes, covering the lithium, cobalt, and nickel markets, with a focus on the drivers from plug-in electric vehicle sector. I want to clarify at the start that our definition of plug-in electric vehicles, or PEVs, includes pure battery electric vehicles, BEVs, and plug-in hybrid electric vehicles, or PHEVs. So the global chip shortage has dampened overall car sales, and it is now constraining PEV sales growth. The UK and Germany saw their weakest August auto sales since 2013 and 1992 respectively. This caused a drop in both countries' August passenger PEV sales, though year-to-date passenger PEV sales have more than doubled in the two markets. In China, despite a year-over-year decline in the overall car sales in August, the country still saw passenger PEV sales up. This was pulled up by record penetration rate, which hit 19.8%, so close to the 20% penetration rate target the central government set for the country for 2020. For the rest of this year, the auto industry has its hopes dashed for production catch-ups in the third quarter, now with widespread extensions to downtime and production cuts, which is likely to suppress the overall potential for the passenger PEV segment. Now, the global chip shortage is happening at a time when the EU and the US are ratcheting up their PEV promotion policies. Both markets are proposing for stricter CO2 emissions rules for new car sales. The EU led global passenger PEV sales growth last year from the introduction of tougher emissions penalties, which compelled automakers to sell more PEVs at the expense of internal combustion engine vehicles. Now the EU is calling for an even larger cut in new car fleet emissions of 55% from 2020 levels by 2030 under the Fit for 55 climate proposal, compared with a 37.5% cut under existing requirements. The US is also proposing to lower new car emissions by a further 7 to 15% between 2023 to 2026. And this proposal has the aim of helping President Biden in reaching the national goal of achieving at least 40% PEV penetration by 2030. Now, for the rest of this year, we actually expect stronger push in passenger PEV sales, especially from seasonal strength in the fourth quarter, led by regulatory compliance in the EU, and as automakers in China aim to hit bigger full-year sales figures. We mentioned earlier that despite the upside in the second half of the year, the overall global sales picture will still be dampened. So the full global sales potential will be impacted by the chip shortage, which will suppress the biggest potential for global PV sales. Over for the next 5 years, we expect Europe and China to lead the sales growth. Europe and China are expected to account for 80% of global passenger PV sales this year, and the total sales volume is forecast to increase by more than fourfold to over 30 million units in 2025. And China and Europe, the two markets, will lead the global increase. Now, battery metals prices have been volatile, and these are driven by short-term mismatches in market fundamentals and concerns over longer-term supply availability. And these are compounded by speculative activities as well. Lithium, cobalt, and nickel prices have increased 49%, 52%, and 13% respectively, yet through to the end of August. In lithium right now, we are seeing severe tightness in the lithium chemicals market as suppliers are unable to keep up with record demand. And lithium raw material producers, they stored production plans and froze development capex last year amid demand uncertainty and low prices, which has now come to bite. Producers are unable to expand fast enough to meet the surging demand this year. For cobalt, low handling efficiency in Port of Durban in South Africa, which is the continent's main port for cobalt exports, continues limiting supply availability to end users 18 months after port disruptions first started. And the constraint on cobalt supply have supported prices. Our nickel prices have been swayed by doubts over long-term battery nickel sufficiency and short-term market jitters on the direction of the global economic recovery. But on balance, nickel prices have risen this year, though the rate of increase is the slowest among the three battery metals. Now, comparing the aggregated impact of the price increases, we see the active metals cost for lithium iron phosphate or LFP batteries have increased 135% this August compared with 12 months ago. And for nickel manganese cobalt batteries or NMC by 56 to 58%. From the chart on the right-hand side, we can also see that LFPs have significantly lower battery metals costs compared with nickel and cobalt-based batteries. Now, the choice of battery technology for PVs is crucial in determining future lithium, cobalt, and nickel demand. And the trend is toward higher uptake of LFP and nickel-intensive NMC-based batteries to reach an optimal between the trade-off in battery raw material cost and performance at both ends of the vehicle price spectrum. And the conscious decision to move away from cobalt is also driven by the need to reduce supply concentration risk, as around 70% of world's mine supply comes from the Democratic Republic of Congo. However, the PV supply chain faced challenges, especially around safety concerns and fire hazards, as it moves to commercialize and expand nickel-intensive battery production like NMC 811. We expect the share of nickel-intensive NMC batteries, so those with 8 parts of nickel and above, to increase from 4% in 2020 to 34% in 2025, and LFP share to increase from 11% to 26% over the next 5 years. And these increases are at the expense of declining shares of NMC 532 and 622 batteries, which are the most popular battery chemistries today. Now, going out to 2025, the speed of growth in overall lithium, cobalt, and nickel markets is directly linked to their passenger PV share of overall demand today. We expect lithium to see the highest demand growth among the three battery metals, as lithium consumption intensity is relatively stable across the different battery chemistry types, and that passenger PV demand accounts for a very large share, so nearly 50% of lithium demand today. Nickel is the largest metals market, but passenger PVs accounted for 4% of demand last year, with the vast majority of nickel demand still being consumed in the stainless sector. So total nickel demand is forecast to experience the slowest growth rate, even lower than cobalt, despite rising nickel intensity in batteries. We still expect total cobalt demand to rise nearly 70% over the next 5 years, as the high passenger PV sales figures offset the impact of cobalt thrifting in batteries. Tesla, a key proponent of cutting down cobalt in batteries, echoes this view and commented that cobalt will continue to be an important material in the short term, according to the company's recently released impact report. Now moving on to supply, we forecast lithium raw material supply to rise 156% between 2020 and 2025, supported by price incentives driving expansions to meet surging demand. The largest producers today, Australia and Chile, will dominate the lithium raw material supply growth, led by their brownfield expansions. For cobalt, the DRC dwarfs global reserves and resources and cobalt mine supply, and we expect the region's share of global mined cobalt supply to rise by 5 percentage points to 74% in 2025, led by Glencore's Mutanda restart and China Molybdenum's Tenke-Fukuromi expansion, both located in the country. And then from these charts, you can see on the left-hand side, regions with the largest lithium reserves are necessarily the largest producers, and supply growth going forth will again predominantly come from brownfield expansions in Australia and Chile, but there are also production upsides. For example, Canada will join the ranks of lithium producers growing their lithium production. Now for nickel, the key issue in the nickel market is centered on whether there will be enough nickel supply of the right type to the battery market. Class 1 nickel, typically produced from nickel sulfide ores, has so far been the dominant product and process route in meeting battery nickel demand. And a lack of significant nickel sulfide ore discoveries over the last decade and a lack of new nickel sulfide projects in the medium term really concern investors that there will not be sufficient supply to meet long-term battery nickel demand. Oxide ores in Indonesia will drive nickel mine production growth, and companies like Tsingshan are hoping to commercially produce battery-grade nickel and its intermediates from oxide ores. Whether Tsingshan can successfully do that will have a large price implication. Back in March, the LME nickel price dropped 20% in the 2 weeks to mid-March as Tsingshan signed commercial agreements to supply battery-grade nickel intermediates produced from oxide ores starting in October next month. And so whether Tsingshan can meet the timing and volume according to these agreements will again move nickel prices. So now moving on to our market outlooks. We expect lithium prices to remain high for the rest of this year, supported by stronger PV sales in the second half, especially in the fourth quarter. And as mentioned, these are due to regulatory compliance in Europe and seasonal sales strength in China as automakers try to hit higher production targets. Lithium supply is expected to experience some improvements from the startup of Australian expansion projects before the year end. But all in all, the market is still very tight. We forecast the lithium carbonate CIF Asia price to increase 30% year over year, based on the market tightness this year, to nearly $11,900 and remain elevated around this level next year. We then expect lithium prices to edge down over 23 to 24 as the market moves into a bigger surplus from rising production spurred by investment decisions made year to date in response to strong prices. The market deficit by 2025 is likely to spur a 15% increase in prices to above $11,200 per ton. The cobalt logistics disruptions are forecast to drive prices up 46% year over year this year to $21.29 per pound. We nevertheless forecast price corrections to occur in 2022 and 2023 as supply flows return to normal and the Mutanda restart and Tankafigurumi expansion in the DRC lift cobalt production. But market deficits from 2025 will stoke a strong price reaction, pushing cobalt prices back to nearly $22 a pound. We expect the nickel market to see a deficit this year from the overall robust economic and demand recovery, supporting the 3-month nickel price to rise 31% year over year to nearly $80,200 per ton. Starting in 2022, Tsingshan's production ramp-up in Indonesia will cause the nickel market surplus to widen, and we expect the market surplus to persist in 2025, which will push the average LME 3-month nickel price down to $17,000 per ton. Now you just heard our base case forecast for lithium, cobalt, and nickel. We mentioned earlier the choice of batteries is crucial in driving these metals demand growth, and the battery industry is very innovative, and battery choices remain fluid, especially in the longer run. In early August, we ran battery choice scenarios to see how the 3 battery metals market would be affected and would change from the base case under different battery choice assumptions. The 2 scenarios involve a complete displacement of the most popular BEV battery types today, so a complete displacement of the NMC 532 and 622 batteries with either LFPs or with nickel-intensive batteries. And the scenario outcomes suggest lithium demand in passenger PEVs will be the least affected, while cobalt the most. In fact, cobalt demand in passenger PEVs could see a 59% drop in 2025 from the base case when assuming a high LFP scenario. And under this downside outcome, cobalt prices could decline back to $13 to $14 per pound. So this is the level seen across a number of months in 2019 and 2020 amid excess supply and weak demand. That's nearly $10 to $11 per pound lower than cobalt prices today. We also conducted a deep dive analysis into mine production costs, and then the outcome actually suggests that large copper cobalt mines will remain profitable even under a downside cobalt price scenario, as the higher copper revenue could offset the decline in cobalt income. And this conclusion supports investments in large-scale copper cobalt mines, which we have seen. Now, in a stark contrast, nickel demand will benefit under the nickel-intensive scenario, with demand in passenger PEV batteries 11% higher in 2025 compared with the base case. Nickel could see a reduced market surplus under this scenario, which will support prices rising above our estimates for 2025. We've reached the end of my presentation. Thank you for listening, and thanks again for the opportunity to share our insights into this dynamic market. If you'd like to gain further insights into our battery metals coverage, please feel free to visit the websites indicated here. I want to thank the seminar organizers for having me, and goodbye for now.